Hey everybody, Marty Mazzora here. It's After Hours on Tuesday, the 19th of September 2023. This will be your midweek market snapshot. I will keep this one quick. It'll also be tomorrow morning's message, so I'll send it out in the morning. And it'll be ahead of the Fed's policy meeting announcement that'll come at 11 o'clock our time, Pacific Daylight Time. And there'll be no rate hike because Fed funds futures say there will be no rate hike, and the Fed tends to not conflict with that signal. In fact, rate hikes are over if you look at what Fed funds futures discounts. If the Fed's prepared statement and then Chairman Powell in the press conference work hard to suggest otherwise, that could be problematic for the market. Otherwise, meaning that there's a good chance of a rate hike coming. The otherwise would be something that conflicts with what Fed funds futures are discounting, which is the first rate cut occurring next July. That could be problematic for the market as well. Anything that would be considered dovish or easy with regard to go forward monetary policy would be very welcomed by the market. I think given the latest inflation data, given where oil prices are, given some of the other turmoil in the labor market that we're seeing right here, I would think that the message would be hawkish and that the market could struggle with it. In terms of market action, I'll show you some technicals here in a second that might comport with that view. But as we've learned over the years, anything can happen on Fed Day. As I've been reporting lately, we think recession odds are high enough to be concerned over the next few months. And as I illustrated in last week's midweek market commentary, that would be really bad news, at least from a historical context, for stock prices and another leg down in the current bear market. As I've said, I think on the last two videos, our work suggesting that recession odds favor continued expansion odds has no necessary time frame. The folks who we respect enough to pay for their economic analyses range anywhere from the fourth quarter of this year to the first half of next year to the second half of next year. Interestingly, none of them have a scenario where we don't have a recession sometime this year or next year. There are economists who I think are in that soft landing camp. Boy, I think that one's a tough one. But open to the idea, open to the notion, open to placing our odds on it, which are very low at this point. But we'll continue to parse the data and tell you what we think going forward. So again, like I did last time, I'm going to save the detailed technical analysis for the very end, and I'll tell those of you who have no interest in there when it's safe to sign off. So starting from the back, we're just going to look at breadth today, and then the S&P and the NASDAQ 100 ETF. So this is one of the most troubling charts that I update every week, and this is the NASDAQ Composite Advanced Decline line in the second panel in blue versus the price trend of the NASDAQ Composite above here in the top panel. So this essentially means that the advancers versus decliners on a daily basis is rolling over very hard, and it has been since early this year, and this would be a negative or a bearish divergence. And folks, this has been a really good indicator for us over the last couple of decades, actually. And you can see how it was rolling over before the COVID situation. You can see how it's flattening out before this 11% correction in here. So you can see these various parts, and it was rolling over big time before the all-time high in the NASDAQ, which was in November, I believe, of 2021. So we kind of have that look now. So it's just kind of a reason to be careful. Let's put it that way. The S&P 500 is still trading at a pretty good range above its 200-day moving average. Let me kind of create an analogy using my own personal experience here recently. A few weeks ago, I took a couple of grandkids deep sea fishing off the Central Coast in California, and we chartered a little boat, so there was just the three of us and the skipper. And of course, I had to strike up a conversation on how business is and so on. And he actually was quite conversive on the topic. In fact, he said that I'm calling, quote, I'm calling a recession right now. And I said, really? He said, yeah. He goes, I'm doing fine, but I'm 10% below last year. But he says everybody around him is really suffering. In fact, when we pulled in, he pointed to all these boats that didn't even go out that day, right? So he basically he's just a good guy, relationship guy. I'm sure he has a lot of repeat business, but he's actually doing fine. He's paying his bills, probably saving a little money. But he's still down 10%, and that's 10% hit to his income. It's not a small amount. And he said, everybody else has asked me what my secret is, and I'm not telling him anything. Fishing was great, by the way. So it's not that people are chartering these boats and not catching any fish. It's just in his view that people aren't chartering those boats. Now, we do know people have still spent money on discretionary stuff and experiences, so I'm not going to tell you that he's any kind of a conclusive indicator, but here's my point. There were all these slips that had these boats where their engines stayed cold that day, and apparently, according to my skipper friend, have been that on most days this year. But overall, those who are going out are actually doing pretty well. So here's my point. When I talk about breadth in this context, the S&P 500 is well above its 200-day moving average by like 200 and some odd points, right? But only 53% of the companies in the S&P 500 are actually trading above their 200-day moving average. So half the boats are actually doing better than average. The other half, essentially, a little less than half, are doing below average, some well below average. More so when we look at the very popular 50-day moving average. Now, I will say, though, that the S&P has rolled over, come above it, and then as of today is back below its 50-day moving average, but it's just, call it right on the dot. Only 35% of the boats in the water, so to speak, in this S&P 500 ocean are actually trading above that really key moving average line. So that's breadth. What it insinuates, or what I'm implying, is that it's really not that good under the surface, right? When only 35% of the index's components are trading above their 50-day moving average, when the index is essentially right there, or only half above the 200-day, when the index is way above the 200-day, that says something very not good about the state of business for all the other companies. And we've talked about this a lot this year. If you take out the top 7, then you have the S&P basically is up low single digits on the year. Now, does this poor breadth mean that things are going to fall apart? Of course not. What it means is that there's poor breadth and that a lot of companies just aren't participating. Maybe they will, and we need to be open to that possibility. What it says right now is that they're not, and that says something that's not so great about current conditions. Lastly, on the breadth, the S&P 500 index, the cap-weighted index, is up a whopping 15.7% this year. All the same companies, equally weighted, are up 3.8. That is a massive, massive divergence. So if this is the correct representation of market conditions, then there's a lot of pain ahead. If this is, then there's a lot of growth to be had going forward. So stay tuned. We'll keep you posted. So that's just one area of research that we do, breadth, that suggests that it's probably smart to be very diversified and very hedged right here. The next couple of minutes, I'm going to wade through those crazy charts on the S&P and the NASDAQ 100 ETFs. So anybody who wants to click the X button, please do so here, and have a great day. For the rest of us, let's take a look at the S&P 500. And this time I'll just spend a second on the weekly chart, because I did notice here that the MACD, the moving average convergence divergence, which basically measures momentum, is giving us a sell signal right here. So on the longer term charts, these are slower moving, and in general you could say more meaningful. You can see you got your sell signal back up in here, and went sideways for a while, and then finally rolled over. It kind of went positive. You had a real short-term buy signal, and then kaboom. So it can get noisy. Had a little period there where where you had a buy signal, and then a month or three later you ended up with a sell signal. But notice that we had a bullish divergence. Obviously, we looked at this chart in a previous video, and I was showing a falling wedge pattern on the weekly with bullish divergences. So that was bullish, and that's exactly how that played out, like it should. So now we're rolling back over on both of the momentum indicators. So that doesn't tell a real favorable story right here about the prospects for the market going forward. And then on the 1-year daily chart of the S&P, again, we're back below the 50-day moving average. Today we closed below the 20-day. Again, not a good sign. And we now just have a very nascent sell signal on the MACD, but just, massive bearish look here in momentum. So tomorrow, if Chairman Powell is friendly to the markets and we get a big pop with momentum, we're going to have to butt up against this trend line resistance where we lost it already. And in all likelihood, you're not going to get confirmation here on momentum. So even if we do whipsaw out of this and pound higher for a bit, maybe something that you'd want to fade if you're a short-term trader. And then on the NASDAQ 100, this one's really important because of its concentration. Remember, we looked at this trend line right here off of the January low. So this would be your 2023 trend line. Closed below that today for the first time, and that's not a good sign. But again, could easily see this thing go pounding right back up if the Fed's friendly tomorrow. We do now have a sell signal as of today on the MACD. And we just have, momentum really, really rolling over. So there you have it. I don't need to dig any deeper into the weeds. It's kind of more of the same, except if this breaks down here in a big way, we're going to see this market finally look like it may be taking its next leg lower. I think that happens consistent with, or as I said the other day, typically it's a couple months ahead of a recession when the market rolls over. You can sure see plenty of technicals that suggest that the market's starting to worry about that. I'll leave it there, folks. Appreciate you. Thank you, as always, for watching and listening, and I'll be back soon. Take care. Bye-bye.